you everyone for joining. So today we are going to talk about how do you configure how much leverage you should use for your systems and how do you kind of keep your drawdowns in control. Because traditionally it is assumed that the higher the leverage, the more the drawdown. Although it increases your returns, we'll find ways to increase your returns without necessarily increasing your drawdown to such a great degree. So I'm just going to share my presentation. Is my screen visible, the presentation? I think it is. Okay. So, so normally when you look at your strategy performance, you're going to look at two things. One is your equity curve, and the second is your drawdown curve. So your equity curve tells you what your P&L looks like, and your drawdown is the losses you took in the interim, which temporarily reduced it from the all-time high. So every time you make a new high in your equity, you start measuring how much have you lost since that highest point. That's a drawdown. Now, if you plot a chart of how much you have been lowered compared to the all-time high as a time series, you get a drawdown curve, which is something like this. Now, in a normal trading system, you would expect to see what you call noise, which means some days there will be drawdowns, some days there won't be any. And if you're running it on a longer time frame, say a daily system or a weekly system, then it will still roughly look the same. Let's say you have a trend following system, then when the market is trending, you won't see much drawdown because you will have a mark to market P&L in your open trades. But when the market stops trending, you will see something like the middle of this chart in 2020, when the market oscillates around some price level and you get stopped out multiple times. So the big discussion when analyzing drawdowns is always, how do you know that your system is no longer working? So one way is people say you should have a limit. Let's say you backtest on 5 years of data and you find that your max drawdown was 20%. Now, if you hit 30%, then you decide that your system is no longer working and you assume that your drawdown is too high and you maybe stop trading the system. There's a better way to do it. Typically, what you expect to see, a drawdown is just noise. It's showing that the market is temporarily not giving you favorable trades, but the underlying assumptions are not necessarily false. You will never have a sequence of only winning trades. You're bound to have losing trades. So in the first half of this chart, what you see is a normal drawdown where you get some blips and then it goes back to the all-time high. So what you really want to measure is not so much the extent of the drawdown, that is of course important, but also the length of the drawdown. So for instance, we see that until from the start of the year 2020 to almost to June, all the drawdowns were very short. If you ended up measuring how long it spent in drawdown before going back to the all-time high, it's a very short period, maybe a few days. But as soon as you finish June, now it spends almost something like 3 months in a drawdown. Now, by itself, this is not extraordinary. If it's an intraday system, you could expect a month or so of a drawdown. But normally, a good filter is when you spend more than the average time in the drawdown, you want to stop your system or scale down your leverage. So let's say we notice that it's been abnormally long by this time when we've been in a drawdown without any return to the equity high, and we reduce our leverage by half. So this further 10% that carried on, it would be cut to half. So the idea is whenever your system is trading a market that is not suitable for it, you want to know it right away. And you don't need to wait for a big drawdown to find out. If you're not hitting equity highs regularly, then the market is not probably suited for it. Let's take an example. Now, if you fundamentally all systems can be reduced to two types. Either it's a mean reversion system or it's a trend system. Now, if you trade something like short straddles or any kind of multi-leg options that tries to make money from theta, then you're fundamentally trading mean reversion. You want the market to stay in a range and or at least return to a range. And if you trade any kind of quantitative models based on historical price action or technical indicators or even a spread or something, then you're essentially trading a trend. You're betting that whatever happened in the past, you want it to continue. Now, whether the market is in a trend or not, there are only a finite number of points that you can extract from it. So on the left is what you have a non-trending market, and on the right you have a trending market. Now, even if you had the best trend following system in the world, you cannot make more than how much the market has moved. So if you say that your system is in a drawdown, you want to analyze, is it in a drawdown because my system is not able to capture the market moves, or is it in a drawdown because the market has simply not been suitable for it? Now, if it is the former, then you want to tweak your system or maybe stop it or lower the allocation to it. But if it's the second, where the market itself is unsuitable for it, then there's nothing you can do about it. The system is not at fault. So you don't want to modify your systems in cases where the market is simply not going to give you the points. You only want to modify it if the market is still moving in the right way, but your system cannot capitalize on it. Why does this happen? Why would it be a case where you have a trend but your system is still in a drawdown? The answer is volatility. Now, any trading system, your drawdown will be affected in different ways. If you get very high volatility, then your win rate drops because your stop losses are hit more often. I specifically picked 2020 as an example for this because you had a very high amount of volatility in a very short span of time. You had a normal market until February, and then from the end of Feb to almost the end of April, for 2 months, you had very high volatility. So if let's say you're trading the Nifty and you have a stop of 30 points or 40 points in Jan 2020, it's working fine. Now March comes, your spread has widened, the bid offer itself is maybe 7 points, and 40 points is just a matter of 2 or 3 ticks. Now your system hasn't stopped working, it's just that the volatility is high. So instead of having a 40-point stop, what you needed was a 100-point stop or maybe 150-point stop. Now, of course, if you keep the same position size, then your risk will be much bigger. So you need to cut down on the position size instead. So if you have high vol, your win rate is bound to drop, but for a different reason, which is that your stops get hit more often. Now compare this to low volatility. For example, let's say 2017. If you trade intraday, the day's range in Nifty was not even 0.5%. Now, if you had any stop, even a small one or a big one, it's not necessarily going to be hit, but your target isn't going to be hit either. So high vol and low vol will both affect your drawdown, but in very opposite ways. High vol will lower your win rate because of more stops, but low vol will affect your drawdown by taking away your profitable trades because the market simply won't move. Let's say you buy it at when Nifty is at 8,000 in 2017, maybe it was 9,000, and it stays at 9,000 the entire day, and maybe it goes up 10 points. Now your stop itself is 30 points. So on days where you hit your stop, you're losing 30 points, but on days where you make a winning trade, you're making only 20 or 30 points. Normally, you would expect to make 2x or 3x of your stop loss. So how do you control the drawdown? Because markets will oscillate between high vol, low vol. They're not going to stay at some baseline level of vol. So the worst thing to do is use a fixed stop loss, because in fact, even if you use a fixed stop loss based on points, the Nifty's level itself has changed very drastically. So 5 years ago, the Nifty was something like 10,000 or lower, and now it's at 18,000. So let's say your stop was 20 points, then it was much wider in terms of percentage terms, and now it's actually much smaller. So, or even if you used a fixed percent stop, it's still very susceptible to whether the market is volatile or not. Now, if you keep your stop loss too large, it still affects your drawdown for a simple reason that your winners become much smaller. So your total P&L itself decreases from the big winners, and so your each loss takes away much more of it rather than when your stops are small. So one suggestion, something that I personally use, is a dynamic stop loss. You want to change your stop size. You could have other rules as well in your system to change the stop, but in my opinion, you should also be accounting for volatility. Now, in times of high vol, even if your system says otherwise, you have to increase your stop size and consequently reduce your position size. And in times of low vol, it's slightly tricky because increasing your stop loss doesn't do anything. So in times of low vol, you want either, let's say you track the volatility using the ATR, and so you will have to study your drawdown to understand what level of vol is your system does optimally. Now, if your current vol is much lower than that, maybe just stop running the system. And if your volatility goes higher than what is optimal, then you widen your stop loss. So how do we decide this optimum level of stop loss? So for that, we go to studying what is called the maximum adverse excursion. So this is actually a very simple concept. It's not my chart. I took it from the internet, but it's a very well drawn diagram. So what you're seeing on the chart, the x-axis is your drawdown for each individual trade. So let's say you have a trade in Nifty, you say you go long, and in the interim it drops maybe 1%, 2% before going up, then that's your drawdown in the trade. And this is y-axis is the final profit or loss that you booked in the trade. Now the green ones are all the profitable trades and the red ones are all the losing ones. So what is it showing you? It's showing you that for all the profitable trades, the drawdown was very small. And all the losing trades, the drawdown was much larger. Now, the profitable trades, essentially, again, this is half of the story. What this is showing you is the worst, how much the price went against you before it went into profit, all the green dots. What you want to see is how far do you want to keep your stop loss to keep most of these profitable trades still in there, but while reducing the number of these losing trades. So let's say you keep your stop loss very wide, something like where you have trade number A. It's very suboptimal because you're going to take all these losing trades in addition to your winning trades. It's pointless. You have no need to do this. You might add just a few green trades, like there is one here and these two here. It's not going to matter. They're not going to significantly alter your P&L. You might add 3 winning trades, but you'll add 50 losing trades. Now, if you keep your stop loss here, this is set to be the optimal one. You are capturing almost all your winners, but you're capturing very few of the losers. You are getting rid of most of your losing trades while still keeping almost all your winning trades. Now, you can never find a perfect sort of separation. You will never have a golden holy grail where all your winning trades will come through, but all the big losses will go away. So you have to find a balance. You have to find an optimum level. What you should not do is curve fit this. So if you have AmiBroker or some other software, you should not say just test hundreds or thousands of times to see which one gives you the highest P&L. That's very dangerous because what you're doing is you're optimizing for what has happened in the past and not necessarily going to hold true in the future. So let's say you have a very big trade, such as the tax cuts day in 2019. Almost any level of stop loss would have given you this winning trade. So if you optimize blindly, it will tell you a very small stop loss. So what you want to do is get rid of your outlier trades where the drawdown is very small because they're not telling you anything more. Take the bulk of your trades, say, except for the top five winners and the top five losers. How do you maximize it for the rest? That's where your bulk of your P&L is. Now, if you can find a level where most of those profitable trades will stay in while getting rid of your worst losers, then that's your optimal point. It need not be the highest P&L generating level of stop in, because what you're optimizing for is stability. Because when you run a system, you will see drawdowns, and you want to, if you want to ensure that you stay on course and continue running the system, you want to control your drawdown, the returns will come by themselves. Now, finally, I want to talk about leverage. So the traditional idea is that if you increase your leverage, your return goes up, but so does your drawdown. Now, this is not strictly true, because your drawdown is a function of how much the sequence of winning and losing trades, while your returns is just a sum regardless of what sequence they are in. So let's say you get two winning trades and one losing trade. Now, let's say your winners are only slightly larger than the losers, say 2:1. Now you have plus 2x, and minus 1x. So let's say you're risking 1% every time. So you go up 4%, then you're down 1%. But let's say your winners are much bigger than your losers. Let's say they are 4x or 5x, because your stops are very small. Now you're going to go up 4%, and then only minus 1%. So now you're up 8% to see the 1% drawdown. Essentially, while your drawdown is the same, your trades are very lopsided, which is to say that if you double your leverage, your drawdown may not go up as much as your return does. So there's a ratio for this called a Kalmar ratio, which measures how much is your return versus your drawdown. And for systems where you get very outsized winners, let's say when you do scalping or some kind of trend following on intraday, where your stops are small but your targets are very large, or in fact you may not even have any targets. So in such cases, your trades will be maybe 5x, 8x, or even 10x. Now, of course, you cannot size these trades very large because your win rates are low. You are going to hit your stop often. But for such systems, you want to maximize leverage instead of lowering them, because the more you leverage them up, the much bigger your winners get, but your losers stay the same. So you're still losing maybe 1x on the loser, but you're, instead of making 4x, you're now making 8x on your winner when you double the leverage. So as an example, I took a system from the same year, 2020, that we saw the chart for earlier. And this is at a leverage of 1x. It makes 90% with a drawdown of 7%. Now, when you double the leverage, the drawdown did double, 15%, but the return went up 2.5 times. So your Kalmar actually went up from 12 to 16. Now, this is, of course, an outlier. 2020 is not something that happens every year, but you can do this in lots of ways. For example, you can run a system at higher leverage, especially the intraday ones or the ones with small stop losses, and pair them up with other kinds of systems so that when they do hit a drawdown, you kind of smoothen it by having some other system make up for it. So I'll just quickly summarize what we covered and then open it up for Q&A or in a discussion. So the first is you want to study your drawdown curve as much as your equity curve. you want to adapt your system for different levels of vol or just have an on off switch. So whenever they are unsuitable for the vol, especially low volatility is a problem. High volatility can be dealt with by increasing your stop size. And to do this, you want to actually study the underlying price action or track them with some metric such as an ATR or a range metric like a Bollinger Band, something that tells you how volatile the market is. The second is you want to optimize your stop loss size using the MAE and the MFE. So MAE is the maximum adverse excursion, which we saw in this chart. The opposite counterpart to this is the maximum favorable execution excursion, which means how much has a profitable trade gone in your favor before you exit it. So you want to consider both. I think for stops, you only MAE is the relevant one. Finally, don't curve fit this to maximize PNL, but maximize for stability. So if you have a stop loss of say 40 points and your PNL is X%, if you change it slightly from 40 to 45 or 35, your PNL shouldn't change very much. If it is, then it means you have curve fit your system. It means a few big winners are skewing your results. That's not something you want. Finally, scale up leverage based on the distribution of your winners. So plot a distribution of your winning trades to see how big they are relative to the rest. If your winners are very big compared to especially your biggest winners are very big, then higher leverage is going to be much more useful. Your drawdown goes up, but your return goes up even more, much more than the drawdown. Finally, you want to combine systems whose trade do not overlap. So for example, if you like we saw above, there are two types of markets. You have a non-trending mean reversion suitable market and a trending market. So if like essentially if you combine something like short straddles, which is very popular on FinTwit these days, along with trend following, then you kind of smoothen the drawdowns on both, because short straddles may not do so well when there is high volatility and when markets do reversals in a day or swing both sides, but your trend following system could catch that. At the same time, if you have a very flat market that goes nowhere, then your trend system may get chopped out, but your short theta systems like straddles, triangles, I mean, there's any other ways to do it. Any of those will cover up for the drawdown at the time. So this is in a nutshell how you optimize your drawdown and decide what kind of leverage to use. If there are any questions or comments, please go ahead in the chat. Okay, we have one question. It says, backtesting for 5 to 10 years won't help as we are modifying the system based on scenario. So backtesting should depend on what time frame you're trading the system. If you're trading an intraday system, let's say one that trades on 5 minutes, then 10 years is a very long time to backtest it, because markets change every couple of years. And what was true 10 years ago is not necessarily true today. So your performance from 5 or 10 years ago is not even relevant anymore. Consequently, if you run something for that long a period and find that something used to work then and doesn't work now, or works now but didn't work then, that's not an issue, because markets were very different at the time. You are modifying the system based on a scenario, but essentially you're not curve fitting it. So These are fundamental assumptions that markets will move between high and low wall. This will never really change. It was true 5 years ago and it's still true today. So, I don't think it's a problem because you're not changing your system really. Your system is still trading the same way. The only thing you're changing is how much risk you're taking and, essentially how much leverage you're using. So, another question is, what is curve fitting? Okay, so curve fitting is running an optimizer blindly. And so let's say you are trading a system that uses a moving average. So curve fitting would be to say, let's test all values of moving average from say a 10 period moving average to 100. And whichever shows the highest profit is the one that I'm going to use. So that is curve fitting. And that is very, not something you want to do because it's optimized to something that has already happened, and more likely than not it will not work in the future. Okay, another question is, what should be the optimum in sample and outsample period? So this is subjective because it depends on your time frame. I would say you should go back not based on necessarily a length of the data, but on whether it covers all kinds of markets. So 2017, for example, was a period of very low volatility. 2018 was the opposite. 2019 was somewhat a mix of both. And 2020 was very high volatility. So I would personally say that if you're trading something intraday or short term, 2017 to 2020 is enough to cover all kinds of markets. I would specifically caution against going very far back, such as 2013 or even further back, because even the brokerage, for example, was a different matter. You did not have discount broking at the time. Your intraday systems that are profitable today may not be when brokerage was 5 basis points and it was percentage of the order value. So the kind of patterns that existed have changed substantially. And even weekly options did not exist until 2016 or didn't get liquid till 17. So I think 17 to 20 is a good period. Okay. Another question is, when you go with a short strangle in at the money options, if the market is trending, how will it help with the time decay? So a strangle is meant to make money only when the market is in a range. By definition, it cannot really, be profitable if the market is trending. So you want to make a decision on, have a rule for what to do in such a case. Either you should exit both the legs when it moves a predefined number of points. You can find this based on historical data, say maybe 100 points on the bank nifty, 200 points, whatever. Depends how far your strangle is. If it's at the money, then uh, I don't know, maybe it really depends on how you trade it. But essentially, if it trends, there's nothing. You just take your stop loss and exit. I think the platforms like Stockmark or I think there's several more now that let you backtest and find what's the optimal stop loss for this. Okay, another question is, how do you measure your drawdown curve? So it's very simple. You can make this in Excel if if you have your equity curve or just a list of trades. Uh, you can take your starting value of your account. This need not be actual; it could be notional, and list all your trades below it, the P&L from each trade, and every time you have a P&L, a plus or a minus, you add that or subtract that from uh, your starting balance. So now you have an equity curve. And once you have your equity curve, you just measure on each cell how much is it below the all-time high value. So I don't know if there's any ready-made platform for this, but it's not very hard. It's very it's very trivial to do this in Excel. Uh, okay, so one other comment is some positional systems have very less drawdown without stops. Absolutely. So you do not necessarily need to have stop losses, but ultimately all systems assume that there is some direction. So if you say positional system, let's say one that buys or sells the Nifty or Bank Nifty, then you are assuming that it will go in that direction and you will not have hold it indefinitely, even if it goes against you. So you may not have some hard stop in the system, but you still have a stop loss. So yes, you need not necessarily have a hard stop. You can have just a stop that is dynamic based on how the price action changes. That's fine. One more question is risk management and drawdown optimization the same? So I would say there's a difference. Risk management is ensuring that you do not blow up your account. It means you trade within reasonable size. You do not, sell options beyond the point where a move would wipe out your account, or buy options that are going to expire, go to zero with all your capital, or even technological risks such as maybe your system misfiring and sending the wrong orders. So that's different from optimizing your drawdown, which means you're simply controlling how much you're losing while you're still while your system is still working. Okay, we have another question. At what point will we be able to understand that our system has stopped working, either due to regime change or two times the max drawdown? So we actually covered this in the first slide. I'll just go back to it. So this is an example of a drawdown. This is actually a system that did not stop working, but we could have avoided this 30% drawdown. So let's say you backtested this system historically and you find that your max drawdown is only like 10-15%, and then suddenly you get this 30% drawdown. Now, if I have a fixed rule, such as you just stop running your system if it's 5% or 10%, 2x of your max DD. So my previous max DD was 10-15%. So 2x would be 30. I would end up stopping the system at the worst possible time if I stopped it here. From that's precisely where it turned back from. So the problem with using measures such as stopping when it goes X times of your previous is that you simply do not know at what point it will turn, if it turns at all. So the idea is you don't want to stop it as such, but you want to scale up and down the leverage. So you don't want to wait until it has gone to twice of your max TD. You want to scale down long before it. So in this case, the idea was if you spend much longer than usual in getting back to your all-time equity high, you scale down your leverage. So right here, we would have scaled down our leverage when the drawdown hit 15%. And because we know that it is taking unusually long to get back to the all-time high in the equity curve. So it could go 2x, it could go 3x. We don't know. We're just assuming that the market conditions are unfavorable for it at the moment, and we'll reduce our leverage. So of course, if it goes to maybe 30-40%, I will stop it, but that's a very subjective rule, so I cannot generalize. The recommended solution is to simply measure how long it is taking to get back to break even. So if it's taking longer, then you start reducing your leverage. Could you give us an example for handling drawdown in a particular strategy? So this is precisely one such example. This is simply a trend following strategy that you super trend as a directional system on Bank Nifty, and there's no fancy maths to it. It simply works when the market is trending, and when the market goes flat, choppy, it stops working, which is what happened here. Now, you could have optimized this but like I said, by measuring that, you're normally you would get down to all-time equity highs in maybe a couple of days, maybe a week. But by this time, you have spent something like 3 weeks in drawdown, for an intraday system without any pullback. So at this point, you would control the drawdown by either stopping the system, which is not recommended, or at least scaling down the leverage. So that instead of going from 15 to 30, it would go only from, say, 15 to 20 or so. At that point, if I see that it has started returning to the equity curve, I'll increase the leverage again. Uh, so one question is, could you advise us some sequencing activity that we could do with the current market? Just some idea about strangle and straddle. I'm not quite sure what this means. Mm, uh, would you like to elaborate on that? Okay, yet one more question is, there's a 4 month time drawdown in a trend following system. Would you modify the system or let it work? So, like this slide, wow, again, I'll go back to the slide, just a minute. So in this slide, we see that we answer the question of why do you have the drawdown? So is your system designed for a trending market? If yes, then has it been a sufficiently trending for your system in theory to have been making money? Now, if the answer is yes, let's say for the past 4 months, you were trading intraday and some trend systems are making money, then yes, your system may need some tweaks. But let's say you are trading on a larger time frame and the market simply did not move in a way that would have generated any points, then yeah, then there's nothing to tweak, just maybe lower the leverage. There's nothing your system can do differently. One more question: how do you measure the volatility of a trading system? So we are actually measuring the volatility of the underlying, not the trading system as such. And I mean, it's a rough measure. You can use lots of indicators to see. For example, there's one called average true range, which measures the range that the market price has moved in the last X candles, say 15, 20, whatever. Or you can use Bollinger Bands, which tells you, again, these are all technical indicators. They're rough measures, proxies for how volatile the market is. You can, of course, use the VIX indicator itself, but I mean, it's a predictor of expected future volatility rather than the present volatility. So in most times, implied vol or IV will kind of price in at a slight premium to the actual volatility. But I mean, again, yes, IV is a good measure. So just keep in mind that it is affected by a lot of events as well. So if there is a election or something coming up, then IV will go up before the actual volatility going up. Is it possible to backtest Dow theory and price action trading? Yes, absolutely. Why not? Anything that can be systematically defined is, in theory, backtestable. Uh, Dow theory, by I assume you mean, when you say you have higher highs and higher lows, or lower highs and lower lows. So you can define these mathematically. For example, a high would be, a top, for example, short term would be where all the closing prices before and after are lower than it. So you know that it's a high. And a low will be where all the closing prices are higher than it. And then you calculate these different highs or different lows, and you measure whether they are higher or lower than each other. So you can see that if you get a higher high, then yeah, it's a kind of bull market, and if you get a lower low, then it's a bear market. Okay, one more question is, When I go short strangle in ATM, if the market is trending, how will help with the time decay? So again, this is assuming you should always have a strangle, which is not really the case. You should, there are many different option structures you can trade. You want to configure the right option, I should say, structure for the right type of market. If you just expect that the market is trending, then there is no reason to have a strangle. And if you have a strangle already and the market is trending, there's nothing to do, just exit the strangle. You should have, again, this is something for which you'll need to backtest. You will have to see that, maybe you backtest and find that if the bank nifty moves more than 200 points away from the price at 9:30, then it's probably a trend day. Again, it's all probability, you can never be certain. So at that point, you exit your strangle, or you can exit one leg instead of both legs, or you can just roll the strangle in the direction of the trend. So there are infinite ways to trade this. There is no kind of one single answer, and you will have to test this to find out what you want to do. Because I cannot exactly know how you're trading, and your risk profile. For example, like, let's say you have the ability to keep selling more strangles even if the market moves. So then if you, let's say, sell a strangle every 100 points that the market moves, then that's a different kind of strategy than just selling it once and exiting right away. One more is, does equity curve trading reduce drawdown? Yes, it can, but it can also reduce your return. So again, like, because you are essentially now adding another layer of complexity on top of your system. And if you trade your equity curve, it's kind of like trend following on your equity curve. Now, if you react to an equity curve decline by reducing your size, yes, you are also reducing your drawdown, but note that you're also reducing your chance of recovering back to the high, because your trades are now smaller than the trades when you lost money. So there's no single golden rule for it. It's subjective. If you think that your drawdown is because the market was unsuitable for it, then increasing your trade size will actually be better if the market returns to how it was optimally. Let's say market was trending and then you had a high return, then the market started being range bound and you had a drawdown. Now you think that the range bound kind of price action is about to be over, so you scale up your size. Now your drawdown will actually recover faster. So again, I think the idea is you should use a first principles approach. You should ask yourself, where is the drawdown coming from? Is it because the market itself is not moving the way it should for my strategy? Or is it because my strategy is not able to react to the market, even though it is moving as it should? When I say market is not moving as it should, it means either one of two types. Either it's trending or it's consolidating. So if your strategy is supposed to make money from consolidation and the market is consolidating, but you're still not making money, yes, then your system may need a tweak. How do you build a system based on Dow theory? So I don't know. There's no specific answer. There are thousand ways to do it. You could simply, just have a system that buys on higher highs and sells on lower lows. These are very kind of broad filters. You will get hundreds of trades if you just run on Dow theory, because there are 2,000 stocks on NSE. You will always have something that fits your criteria. So you should ideally combine these with other filters so that you trade a very small universe of stocks, like say the Nifty 50. Otherwise, you will end up with 50 or 100 trades every week. Okay, so I think that covers almost all the questions.